Hello everyone, this is 오준혁, 최소렴, 김서윤, 이경윤, 김호정. We'll start our presentation for our final project of the 2024 fall semester. Interest rate, with its dictionary definition of the proportion of a loan that is charged as interest to the borrower, is one of the most essential indexes in the field of economics. It may function to reflect various economic or social outcomes, or the change of it can arouse diverse economic or social outcomes. That is why that is why it is important for economic experts to accurately forecast the future interest rates, so that different parties of the economy, households, companies, or governments can design their own plans to protect their losses or extend their profits that can be aroused from the change of interest rates. Based on the importance of accurate prediction of interest rates, as mentioned, our group has conducted a project to forecast the future interest rates of United States and Republic of Korea. We've divided our forecast into 5 parts, which consist of an analytic approach to short and long-term prediction of both nations. For the case of short-term forecasts, we have focused on the future 6 months change, which deals with the interest rates of the first half of the year of 2025. On the other hand, in the case of the long-term forecast, we have focused on forecasting the interest rates of the following 3 years, which covers the year of 2025 to 2027. In addition to the analytic approach to this project, based on the historical data of interest rates from 2010 to 2024, we've extracted the data of expected future interest rates through computer programming. For the US, we used the federal funds effective rate from the Fed, and for Korea, Bank of Korea's key interest rate from the ECOS, Bank of Korea's open API system. We conducted our research using the ARIMA model. ARIMA model is based on the auto-regression models and moving average models, which makes it a powerful tool for analyzing the time series data to understand past processes and predict future values of time series. Through this model, we'll acquire the monthly data for the future 3 years expected interest rate of the US and Korea. Through the quantitative analysis on two nations' interest rates, we ended up in the conclusion that both nations' interest rates will decrease in both the short and long futures. For the US, we're expecting a gradual decrease from the rate of 4.4% to 4% in the short term, and ending with the long-term rate of 3.6% in November of 2027. For Korea, we're expecting a gradual decrease from the rate of 2.9% to 2.6% in the short term, and ending with the long-term rate of 2.1% in November of 2027. Also, we're expecting the rates of both nations to converge near the value of the last period of our forecast. The values extracted from the quantitative analysis will be further discussed in our presentation report.
First of all, we will present our analysis of U.S. short-term interest rate trends and predictions through mid-2025. Let me begin with the current federal funds rate and its historical context. The federal funds rate set by the Federal Open Market Committee is the interest rate at which banks lend to each other overnight. As of November 27, 2024, the FOMC set the target range at 4.5 to 4.75%. Historically, interest rates have shown distinct patterns. For example, from 1970s to 1980s, rates surged above 20% during the Volcker era to combat stagflation, but triggered a recession in 1981 to 1982. During 2008 financial crisis, rates fell to near 0% to stimulate the economy, beginning a prolonged period of low rates. After 2020 pandemic, rates were again reduced to near 0%, but have risen rapidly since 2022 to control inflation. Historically, rapid rate hikes often precede recessions, as seen in the early 1980s and 2008. Conversely, during recessions, rates are typically slashed to stimulate recovery. This pattern suggests that once inflation stabilizes, the Fed may lower rates. Let's now examine the economic factors influencing rate decisions. First, the Personal Consumption Expenditures Index measures the changes in the prices of goods and services purchased by the consumers in the US and is considered the Federal Reserve's preferred inflation gauge. The Core PCE Index, which excludes volatile food and energy prices, is used to gauge the underlying inflation trend. PCE rose by 2.3% year over year in October 2024, while core PCA reached 2.8%. Both remain above the Fed's 2% target, indicating persistent inflationary pressures. To curb inflation, the Fed is maintaining rates at 4.5 to 4.75%, with a cautious stance on rate cuts until inflation is firmly under control. Next, GDP growth slowed slightly from 3.0% in quarter two 2024 to 2.8% in quarter three, reflecting steady but moderate expansion. If the current growth pace continues, the Federal Reserve may maintain interest rates at current levels or consider gradual rate cuts if inflationary pressures ease. The unemployment rate rose from 3.8% in October 2023 to 4.1% in October 2024, the highest since early 2022. This labor market cooling suggests the Fed may pause further rate hikes and hold rates steady. Stock market indices like the S&P 500 reflect investor confidence in the economy and consumer sentiment. The S&P 500 has risen by 26% in 2024, but recently plateaued. If the S&P 500 continues to decline and market volatility increases, the Fed may consider accelerating rate cuts to stabilize the market. The CCI rose to 111.7 in November 2024, up from 109.6 in October, indicating optimism among consumers. Retail sales grew by 0.4% in October 2024, surpassing expectations of 0.3%. Sustained high confidence and strong consumer demand could increase spending and keep inflationary pressures elevated, prompting the Fed to hold rates steady or even consider slight increases. Lastly, let's look at some global factors. The DXY index at 105.78 reflects a strong dollar, which is easing inflation by reducing import costs but affecting export competitiveness. WTI crude oil prices fell to $68.15 per barrel, down 3.66% this year, stabilizing energy costs and reducing inflationary pressures. Central bank policies such as potential rate hikes by the Bank of Japan and steady or rising rates by the European Central Bank could weaken the US dollar by strengthening their respective currencies, which may drive inflationary pressures in the US and prompt the Federal Reserve to adjust its policy stance accordingly. Based on these data, through the first half of 2025, US short-term interest rates are most likely to remain steady at 4.5 to 4.75%. A strong dollar and stable oil prices ease inflationary pressures, while resilient consumer confidence and retail sales support economic growth. However, a cooling labor market and external factors like ECB and BOJ rate policies reduce the likelihood of further hikes.
I'll present our analysis of U.S. long-term interest rate forecast through 2027. We discuss monetary policy actions and global issues as essential economic indicators for short-term interest rate forecasting. These factors, including both internal and external economic conditions, all have an impact on long-term interest rates. These indications set the setting for the Federal Reserve's upcoming interest rate decisions. For inflation, the FED targets a 2% inflation rate, and while inflation has moderated to 3.2%, it remains above the target. Core inflation, excluding volatile items like food and energy, is still a concern, especially in services. For labor market, the unemployment rate has slightly increased to 4.1%, signaling some cooling in the labor market, but it's still near historic lows. Ongoing labor shortages fueled by demographic shifts will likely keep wage pressures elevated, which could prevent inflation from falling to the target range quickly. For economic growth, the U.S. economy grew by 2.8% in Q3 2024. While growth remains steady, the pace may slow as the FED's interest rate actions continue to take effect. Currently, the Federal Reserve's federal funds rate is 5.25% to 5.5%, the highest level since 2001. The FED's decision to hike rates in 2022 to 2023 was aimed at combating high inflation, which peaked at 9.1% in mid-2022. recent rate cuts. In September 2024, the FED began to cut rates by 50 basis points. These cuts are expected to continue, but at a gradual pace as the economy adjusts to these changes. Despite high borrowing costs, the economy has shown resilience and GDP grew by 4.9% in Q3 2023. This will be important as we look ahead at the FED's forecast for 2024 to 2027. I'll now discuss the Federal Reserve's interest rate forecast for 2024 through 2027. The FED is adjusting its rates to balance inflation control with economic growth. This is the economic projections of the FED funds rate. In 2024, the Federal Reserve has already reduced rates to 4.25% to 4.5%, and additional cuts are expected by the end of the year. This will be a gradual process, with the FED looking at economic data to determine whether further small cuts or a larger 50 basis point cut is needed. In 2025, the FED is expected to continue cutting rates gradually. Projections indicate rates could reach 3.25% to 3.5% by the end of the year. However, structural inflationary pressures like labor shortages and supply chain issues may slow the pace of these cuts. By 2026, the rate is expected to stabilize at 2.75% to 3%. This reflects a move toward a more normalized rate environment after years of ultra-low rates during and after the pandemic. The FED will likely pause further cuts to assess the long-term impact of previous rate reductions. And by 2027, the federal funds rate is projected to remain stable at 2.75% to 3%. This rate is consistent with the FED's longer-term projections balancing inflation control with sustainable growth. To summarize, the Federal Reserve's interest rate policy over the next few years is focused on maintaining economic stability while managing inflation. By 2027, interest rates are expected to stabilize around 2.75% to 3%, which is a more normalized rate environment after the pandemic's ultra-low rates. The gradual rate cuts expected through 2024 and 2025 reflect the FED's efforts to balance supporting growth while controlling inflation. By 2026, we'll likely see rates stabilize as the economy adjusts. These projections highlight a shift towards long-term stability, but the pace of rate changes will be data-driven, with the FED closely monitoring inflation and employment factors.
I'll now discuss South Korea's current interest rates and our short-run forecast up to June 2025. In our analysis, the short run is defined as the period up to June 2025. As of November 28, 2024, the Bank of Korea has set the policy interest rate at 3.0%, following two consecutive 25 basis point reductions in October and November. This marks a shift toward a more accommodative monetary policy, reflecting the central bank's efforts to address economic challenges, such as weak domestic demand and sluggish export growth. First one is weak domestic demand. Private consumption, which accounts for nearly 50% of GDP, fell by 1.5% in Q3 2024. This decline indicates that consumers are spending less, which can slow down economic growth. This ongoing weakness is a significant drag on the economy. Second one is sluggish export growth. Above graph shows a year-over-year percentage change in South Korea's exports over time, based on data from the Ministry of Trade, Industry, and Energy. In October 2024, exports grew by 4.6% YoY, down from 7.5% in September. In November 2024, growth dropped further to 1.4% YoY, signaling weakening global demand. The trend suggests a continued decline in export momentum, influenced by external factors such as: first, slugging global demand; second, weakness in key sectors like semiconductors; third, reduced trade activity with major partners, especially China. Recognizing these challenges, the current monetary policy focuses on supporting domestic consumption by reducing borrowing costs and easing household debt burdens, particularly for families with variable rate loans, and stimulating business investment to offset weak global demand. By analyzing this transition, we can identify a clear pattern. The BOK is now focused on reviving the economy through accommodative measures. This informs our focus for the first half of 2025. Therefore, based on current economic indicators, the recent policy actions of the Bank of Korea, and the International Monetary Fund's IMF November 2024 outlook, we predict that the Bank of Korea will likely maintain the base rate at 3.0% in the short term. Weak domestic demand has been identified by both the IMF and the Bank of Korea as a key drag on growth. The IMF's GDP growth forecast of 2.2% for 2024 and 2.0% for 2025 reflects this weakness. Therefore, maintaining the 3.0% rate can help stabilize consumption without increasing household financial burdens. Additionally, as South Korea's semiconductor exports fell by 12.7% in October 2024, and total export growth dropped to 1.4% in November, the Bank of Korea must rely on domestic demand to offset these weaknesses. Thus, making the current rate of 3.0% will be a prudent choice. Overall, unless inflation unexpectedly rises or growth drastically deteriorates, we anticipate that the Bank of Korea will remain the rate at 3.0% through June 2025. To conclude, due to South Korea's recent economic challenges, such as weak domestic demand and sluggish export growth, the BOK lowered the interest rate to 3.0% in late 2024. Looking forward, we expect the policy rate to likely remain at 3.0% by June 2025, depending on how domestic and global economic conditions evolve. The BOK strategy reflects a careful balance between supporting growth and maintaining financial stability.
Finally, I will provide a broader perspective on the factors that influence South Korea's current decision in monetary policy. Specifically, I will explain how U.S. Federal Reserve policies, the domestic housing market, and inflation trends have shaped South Korea's interest rates, and conclude with an outlook on future rate movements. Between 2014 and 16, the Federal Reserve raised rates, while South Korea kept its rates low to stabilize its economy. During the pandemic in 2020 and 2021, the Fed cut its rates to near zero, and South Korea followed by reducing its rate to 0.5 from 0.5. From 2022 to 2024, global inflation drove aggressive Fed rate hikes, leading South Korea to raise its base rate to 3.25%. This outlines how South Korea's monetary policy closely followed the Federal Reserve's interest rate decisions from 2014 to 2024, balancing domestic economic stability, inflation control, and currency stabilization in response to global financial trends. Domestically, high interest rates between 2022 and 2024 curbed speculative investments and borrowing, slowing housing price growth. By late 2024, with rates steady at 3.25%, the housing market showed signs of recovery, with the housing price index rising 0.3% month-on-month in September. This suggests gradual rate cuts could support growth without risking a housing bubble. Between 2008 and 2009, South Korea's base rate dropped from 5.25 to 2%, while CPI rose slightly from 81.606 to 83.906, showing controlled inflation despite aggressive rate cuts. In 2020 and 2021, the rate was reduced to 0.5%, leading to CPI increasing from 100 to 103.35 as demand recovered. After that, CPI surged to 111.59, driven by global inflation and post-pandemic recovery. And the base rate was raised sharply to 3.5%, successfully slowing CPI growth to 114.4. This demonstrates how timely rate hikes effectively curb inflation while maintaining economic stability. Looking ahead, South Korea's interest rates are expected to decline gradually over the next 3 years. The base rate is forecasted to drop from 3.25% to 2.5% by late 2027, reflecting the Bank of Korea's focus on stimulating economic growth while maintaining financial and price stability. The forecast for declining rates is supported by 4 main factors. Firstly, stable inflation. As of November 2024, South Korea's inflation rate has stabilized, creating room for potential rate cuts. The CPI increased from 109.16 in October 2022 to 113.27 in October 2023, reflecting an annual inflation rate of 3.77%. Although slightly above the 2% target, this marks significant stabilization compared to earlier global inflation pressures. This controlled inflation gives the BOK flexibility to reduce rates without risking price instability, allowing a focus on growth. Next, South Korea's GDP contracted by 0.2% quarter-on-quarter in Q2 2024, the first decline since the COVID-19 recovery. Year-on-year GDP grew 2.3%, showing mixed economic signals. The contraction was caused by weakened exports, decreased private consumption, and sluggish investment. This contraction raises expectations for rate cuts to stimulate borrowing, revive consumption, and encourage investments. The Housing Price Index increased by 0.3% month-on-month in September 2024, signaling early recovery after cooling from high rates. Between 2022 and 24, sharp rate hikes reduced speculative investments and borrowing, slowing house price growth. Lower rates could further ease borrowing costs, boosting housing demand and broader economic recovery. This highlights the close relationship between interest rates and housing. While rare careful reductions can support sustainable growth without creating a bubble. Lastly, the U.S. Federal Reserve's recent rate cuts to 4.5 in late 2024 indicate a global shift toward easing monetary policy. This offers South Korea a chance to align its rates without risking capital outflows or exchange rate instability. In summary, South Korea's current and future interest rate decisions will continue to be shaped by global trends, domestic inflation, and economic recovery needs. A gradual reduction in rates, supported by stabilizing inflation and recovering growth, will help balance economic recovery and financial stability over the next 3 years.
In conclusion, our analysis has revealed notable trends and factors shaping each country's monetary policy decisions. For the US, we expect both short-term and long-term rates to decline gradually as the Federal Reserve navigates a delicate balance between controlling inflation and sustaining economic growth. By 2027, US rates are projected to stabilize at around 2.75% to 3%, reflecting a return to more normalized monetary policy after a period of aggressive rate hikes. For South Korea, a similar trajectory is anticipated, with rates forecast to maintain 3% for the short term and eventually decrease to 2.0% to 2.5% by late 2027. The Bank of Korea's accommodative stance aims to address challenges such as weak domestic demand and slowing export growth while maintaining financial and price stability. Both nations are expected to see convergence in interest rates over the long term, driven by shared global economic factors and their efforts to support sustainable growth. Our findings emphasize the critical role of data-driven forecasts in economic decision-making, allowing governments, businesses, and households to adapt their strategies effectively. This project underscores the importance of interest rate predictions in shaping the future finance landscape. Thank you.